All right, ladies and gentlemen, welcome to Macro Ace with your host Tony, also from Financial Juice, the head analyst there. What I'm going to do is run you through GDP Advance, what it means, why it's important to look at this release, and how it affected the markets beforehand. So usually we don't cover GDP because it's old bit of data that's compiled together, and the markets would have already taken in other economic releases such as non-farm payrolls, the unemployment rate, consumer spending habits, retail sales, or consumer spending overall, which we'll get tomorrow for the month. This data we're going to be getting the quarterly data for consumer spending. But for GDP Advance, it has had a very strong reaction in the past, particularly in currencies and for gold. So it was something that I was kind of teetering whether or not we should cover it. And I'd recorded a video and done a bit of testing, and to see whether or not it is a release worth covering. But yes, it definitely is something to definitely cover. We'll go through it here, what it means, why it's important, the fundamental effects, what is the current sentiment surrounding the markets at the moment, what are analysts expecting, investment banks, what has the government said, and what has the central bank said yesterday as well from Fed's Powell's FOMC press conference. So that's what we're going to go through here, and hopefully you'll find the information that I provide you is useful. But yes, let's get right into it. So GDP, so gross domestic product, represents the total dollar amount of all final goods and services, even if it's on the shelf or in storage, or that hasn't been sold yet. Hey, good day to you, Scotch and Stocks. But yes, so it represents the total dollar amount of all the goods and services that are within the economy. Okay, so that shows, and it's also at an annualized rate as well. So what that means is it's just showing you that GDP for the quarter, how slow or fast the economy is growing, and if that's likely, and that will show you the rate of how that's going to be sustained in the future. So if it is minus 1.6% that we had as the final read last time, then the economy is expected for the rest of the year to go at that rate, or to produce at that rate of minus 1.6%. So that's what annualized rate means. Okay, so what is the US? How slowly, or how quick is growth expected to be for the rest of the year from that quarterly data? And the reason why the US does that is it just makes it easier to forecast for what to do with the government spending, and also for businesses as well. You know, if GDP has come in worse than expected, maybe there's parts of the report that are showing that there is a decline in spending in some areas from, not only consumers but also the government too. But that then again is more of a forecasting tool for businesses. And if we keep going on then, so the fundamental effects of GDP. So if you want a healthy economy, well, you would want a higher real GDP, right? Now, when we say higher real GDP, we're talking about removing the effects of inflation, okay? Some of the other economic releases like retail sales will include the effects of inflation, and they can have big whipsaws here and there and make it less reliable compared to some of the other spending reports. But for GDP, again, same thing again, it's easier to understand what's actually going on within the economy. So the real GDP figure, or the GDP figure that strips out inflation, is the one that's focused on the most for everyone, no matter whether you're a trader or an economist or from the government or the central bank. So again, higher real GDP improves the standard of living. However, GDP growth due to inflation could erode living standards because people pay more for the same goods. And GDP can be used as a report for the White House and the Federal Reserve to view how well or poorly their policies are working. So, of course, real GDP is great to have a look at, but then, of course, you'll be looking at the GDP, which includes inflation, or part of that report. And if inflation is elevated that bit too much, maybe because there are higher energy prices that consumers are paying, but also businesses too. And you've got the agricultural prices or food prices that have skyrocketed, and there is a high demand for energy, then that could have that could have more of a that could overinflate the GDP report. So that's why the real GDP report is more preferred one, removing the seasonal factors and also removing the effects of inflation. Then how does it affect the markets then? So the key thing, hello, David Cini. Good afternoon to you too, or Chini. Maybe I've said that wrong. So currency. So robust economic activity can firm up interest rates, which increases the demand for the dollar. If inflation accelerates and stays high, it can lower the US's competitiveness in the world and worsen trade. So of course, we're thinking about, you're talking about the exports and imports, export and import data that we that we have, and how that also feeds in to the GDP report, of course, trying to strip out the effects of inflation. And then for stocks, a healthy economy generates more business earnings, while a sluggish business environment depresses sales and income. However, higher prices will erode households' purchasing power and may force interest rates to go higher. And then for the bond market, very, very simple. Whenever the economy is in the downward trend or not doing so well, that's better for bond prices, because traders and economists, or traders and investors, will jump to bonds to try and keep their money safe from the tailwinds or the potential hurricane that could come with a recession or a depression. So bond markets would react positive. The bond market prices would react positively to negative GDP data, and that's what we saw last time round with the first advanced data that we had for the first quarter of this year. If GDP figures exceed expectations and inflation pressures are rising at the same time, interest rates may be raised, meaning that bond prices will lower and yields will rise. So better than expected GDP figure. I think not only would you get a positive reaction from the dollar, but considering the reaction that we had last time from the first quarter advanced GDP, you'd also could see a positive reaction from stocks. But same thing again for bonds. Bond prices would start to head lower if the economy is doing really, really well. Then if we're looking at the last GDP report then, so we can see that, this is just showing you here that, so of course, the real GDP decreased by 1.6% for the quarter. This is the final read, by the way. And you can see here that non-durable goods manufacturing had decreased. Now, part of that could also be because of one of the other things that could be is that the higher energy prices means that businesses are not able to produce as much as they want to. And there are also supply chain issues that are occurring. So non-durable goods, you're thinking about your food, your clothing, and all the products that last 3 years or less than 3 years. Okay, that have a short life expectancy. So those products had seen a huge depreciation in the private goods producing area for non-manufacturing goods. And retail trade was also down as well for the first quarter. You've also got to bear in mind you had the COVID pandemic that had meant that there wasn't that very strong demand for products if countries were going into lockdown. So you wouldn't see strong retail sales figures. Finance and insurance, again, similarly, you can blame it on COVID. Of course, having to borrow a lot more money, and then maybe there are people who are having to start to pay back their debts to those commercial banks that they would, and also businesses as well. So that could also have dropped off as well also the issuing of credit too. And then if we're looking at the flip side, the stuff that had seen an appreciation, you can see that with the government spending, you can see that state and local government spending had actually increased by 0.24%. And you can see that, of course, again, same thing is with COVID, providing the stimulus checks, or providing more money to people who are filing for unemployment benefits instead. And then other areas too, so retail estate and rental, and leasing is also quite important too. Of course, cheaper prices or less demand for housing, when house prices started to go down a little bit during the COVID pandemic and then started to slowly rise up because there is more of a demand for housing. Then that had also seen an increase as well. Key thing here is durable goods manufacturing. Okay, so durable goods are those goods that have a life expectancy of 3 years or more, and that can show how strong the economy is, or the expectation for the future. If you remember watching one of the webinars that I did about trading economic releases, or how to trade economic releases, you will remember that durable goods is one of the more or less predictive measures of how the economy could perform in the future. And that's quite key within the report itself. Now, if you see a big drop off in durable goods, then the demand, you've got to take it that the demand for durable goods such as PCs, refrigerators, and more high-end spending is dropping off, right? But if you see a healthy pickup like we did yesterday with the durable goods data, when we had seen that come out, that was much better than forecasted. And actually, what we had seen is the dollar had seen an appreciation. The S&P 500 had seen a depreciation, as did gold as well. So you would have also expected bond prices to head lower as well, because the US economy is still shown to be, for the last month, is still showing to be quite resilient. Or much better than expected compared to what economists were forecasting. So that's what we've got to be aware of, is that, you can't just say, yeah, the US economy is in a recession. Well, technically, you can say GDP growth, if it's declining, you could say, yes, it is. But there are also other factors too. I'm trying not to sound like Fed's pal or the Treasury Secretary Yellen, but it's true. You've got to look at other factors that affect the economy too, like jobs, like consumer spending, the unemployment rate. How is the housing sector or housing market doing at the moment as well? So, but this was the prior report that we had seen. So if we keep going on, so the government's view then. So on Sunday, and on an NBC interview, had Treasury Secretary Yellen said the U.S. state economy is slowing, but isn't in a recession. It's in a period of just growth slowing. So they're expecting GDP to be, slightly smaller than that they would expect, because of course with rate hikes. If you remember yesterday in the video that I did for the FMC, whenever interest rates are raised, borrowing costs rise, or when borrowing costs rise, that means that there is less spending that occurs, or less borrowing that occurs to either purchase the goods that businesses are making, or for businesses, to be able to produce more. Of course, businesses will love low interest rates, but then of course with the really low interest rates for a very long time, you get sky high inflation, and you get the likes of a 9.1% inflation or a 40-year high for the US from that. So there is a need, from what Yellen is saying, to kind of slow down growth to a degree, but not enough for the US economy to go into a recession. Now, you also have that many experts, they predict that the second quarter will be negative, and the first quarter GDP was negative. Also, Yellen saying that we might see that happen, and she was saying that in an interview on Meet the Press. So she said that we could see a negative GDP figure for the second quarter, kind of, of course, giving markets the expectation, what to expect. Now, the problem is everyone's more or less was trying to price in what the Fed were going to do for the FMC yesterday. So you didn't really have a lot of pricing going in for GDP. But it was more so this week. It was, and since the last FMC of pricing in for the next FMC. But if we're looking at the market so far, so the Dixie at the moment up 0.4%, the S&P 500 down about 0.2%, gold up by 0.26%, And those are going to be the key things we're going to be looking out for. So if I look at the US 10-year bond as well, where we are. So the US 10-year bond currently up about 0.05% at the moment. But again, that's what we're currently dealing with. So dollar is higher on the session, S&P lower. We could see a further, if we do get negative GDP, we could see both the dollar and the S&P 500 going down in instead if we go into the negative territory. Now remember the expectation for GDP, and we'll look at what investment banks are expecting. So the expectation for GDP is for an expansion of 0.5% from the prior of minus 1.6%. And then we're also looking at other areas too. So the PC prices advance, or the core PC prices advance for the quarter, expecting 4.4% versus prior 5.2%. The GDP deflator advance with a forecast of 7.9% and a prior of 8.3%. Also the forecast then from Deutsche Bank, what they expect. So they expect GDP to come in at minus 0.6%. Bank of America minus 1.5%. Citi with a forecast of 0%. Goldman Sachs with a forecast of 0.5%. And JP Morgan with a forecast of 0.7%. Okay, apologies for that. But yeah, so looking at the investment banks, they're expecting, you've got a couple of them expecting a decline in GDP, and whereas the others you were expecting a bit of an expansion. And for ourselves, so according to the median, according to other economists too, they're expecting a high estimate for GDP at 2%, with a low estimate of minus 2.1%. So there's a big deviation that these economists are expecting. Okay, so of course with 2%, they're expecting a 1.5 deviation on the high end, and and if we're looking at 2.1%. Of course, just on the low end, expecting if we're looking at the low end, expecting a minus 2%, 2.6% deviation, or 2.6% deviation on the low end for what the median estimate is for economists. But again, so you're looking for quite big figures then, or big deviations, in order to try and get some sort of a market reaction from the markets. But also from economist's point of view too. So of course, said the FOMC, the traders were expecting or trying to price in the data for, or try to price in the rate hike. Now it's down to GDP. You know, you get a lot of people, even on TikTok, your people saying we're going to get negative GDP, we're going to be in recession. It's a bit, you see, it's a bit being a bit too sensitive. Like I said, there are other bits of data to look out for. So if we look at other views then, so Fed's Bullard said the GDP numbers may not accurately reflect the economy. And the IMF was what they also said is that they cut their growth projections for the US economy this year and next, and raised its unemployment rate estimate through 2025, warning that a broad-based surge in inflation poses systemic risks to both the country and the global economy. So they expect GDP in the US will expand by 2.3% this year as a whole, and the executive board of Washington-based lender said in its so-called Article 4 consultation released on Tuesday, and also that's less than the 2.9% projected last month when staff concluded a visit for the report. So expecting worse data from the IMF for the year as a whole. And as said, the IMF cut the US GDP and raised the jobless rate forecast on inflation risks, and that they raised US GDP growth forecast for 2024 and 2025 from the June estimate. So again, the inflation being the key thing that is causing people to causing businesses to produce less. If prices are quite high and there are supply chain issues, that's having a big effect on the economy. Then on July 26th, you had IMF chief economist Goran Chas said that there is no US recession in the baseline prediction. And IMF affirmed that the latest US GDP prediction of 2.3% in 2022, down from 3.7% in April and 1% in 2023, and also unchanged from 2.3% in April. Shouldn't say down. And then Fed's Powell. So Fed's Powell said is that a recession is defined as a broad-based decline, which does not appear to be the case right now. And we don't believe we have to have a recession. So key thing here is what he's looking at is the employment data, right? And the housing market data, as well as consumer spending as well. Combining those and sentiment too, combining those all together, you get a better read of where the economy is. And we're not seeing that from what we can see. So if we're looking at where the economy is at the moment, so other than, GDP with the final data compared to the prior showing minus 1.6%, we're looking at CPI being quite high at 9.1%. ISM manufacturing PMI did see a decline to 53 compared to the prior 56.1, but more or less still in an expansionary environment. Remember, any number below 50 will show contraction within the economy. US industrial production month on month was at minus 0.2% versus spot 2%. Durable goods yesterday, the data that we had was, as said, much better than expected at 1.9% versus the prior of 0.8%. Non-farm payrolls data that we also had showed that 372k versus 390k, and the US ISM, that shouldn't be March. That should be June there. US ISM manufacturing, other than that, so we had the University of Michigan sentiment prelim as well, which is at 51.1 versus 50. So there are all these other different factors that we've got to kind of consider where the economy is. So it's more of a mixed picture, is what you could say. It's not a clear-cut thing saying that the US economy is in a recession at the moment. The only thing you can do is just look at some people just look at the productivity, say, yep, that's it, the US is in a recession, but we're not really. There's quite a bit to look at. All right, so we have a look at the other place too. So what I want to do is show you the video for GDP, what I'd found, what I had last time. I'll just bring that up here. Oops. Okay. Hopefully you can all see that. Apologies if it kind of looks odd. Let's see if we can go back a couple of ticks. All right, so I don't know if you can see that clearly. There is, apologies for the quality on the video there. So this is back in April, towards the end of April, that we had this bit of data coming out. Now you'll see, so we've got just to kind of let you know, got the dollar yen here, we've got the S&P 5, we've got that's the 30-year bond, but we've got the S&P 500 there. We've also got gold here as well. So if we continue playing the video, you'll see that the dollar yen had a very big, reaction to it. and wait for the data. And then minus 1.4% was the actual data compared to the forecast of 1%. So you can see bond prices started to move higher. Gold also started to move higher. The S&P 500 had also seen a negative reaction as well off of the back of the data there. Okay, that's just the quality. So apologies for the quality, but you can see clearly the S&P 500 off of that negative figure that we had, and the deviation was 1.4%. Excuse me, the next deviation was 2.4%. Then we had seen a bearish reaction from the stocks, also from the dollar, positive reaction from the bond prices or 30-year bond, and also gold as well. So that's something that we've got to be aware of, is that with a bad GDP data, that's how the stock market reacted. It didn't go up instead off of bad GDP data. Remember, GDP is representing the overall growth within the economy, how fast, how slow it is. So for businesses, as said, if you use as a forecasting tool, if they're expecting a slowdown in production or hiring, that's also something that's been thrown around with the earnings. Then that's going to lead to a GDP that's going to show a decline rather than incline instead. Because if you have less productive businesses, that's going to lead to a smaller GDP figure, and a contraction is what we had here. I had the video quality all set up. Kind of looks like it's a fever dream here at the moment. All right, so we've got about 3 minutes left. Holy moly. 3 minutes left. Okay, tick strike coming up. So this is what the deviation was last time then. So if I just show you how the markets reacted to the data prior. So we'd seen with that deviation of 2.4%, so the S&P is seen about 21 ticks down. And after about 10 minutes of trading, it was about 14 ticks up. The NQ about 78 ticks down, and then after 10 minutes of trading, 78 ticks up. Dollar yen 40 pips down, which had seen the biggest reaction there. I think the key thing is that the Bank of Japan was continuing to look to ease monetary policy, or not to look to raise rates at all, or trying to do any quantitative tightening. So that's why the dollar yen had the biggest reaction. Gold had also seen a very big reaction, had seen a bigger reaction too compared to what it was previously. We'd seen 47 ticks towards the upside. The euro dollar has seen about 15 pips up. Cable about 13.5. If we're looking at the bonds then here, so the 2-year bond had seen 17 ticks up, and then it was flat after about 10 minutes of trading. And the 30-year bond had seen about 6 ticks up. 6 ticks towards the upside, and it was seen about 7 ticks after about 10 minutes of trading. So the key thing here then, I think the key thing to look out for is that, so for the dollar yen, we had seen the most reaction, and also on the 2-year bond price and gold is where we've seen the most reaction curl, the biggest more or less instant reaction. Compared to what we had seen last time with the S&P 500, where it did see a decline, but it wasn't a sharp shoot down as it was compared to the dollar yen. So that's just something to be aware of. But as said, dollar yen had seen the biggest reaction last time, gold and the 2-year bond compared to the 30-year bond. So we've got about a minute left, about 30 seconds. I've got my tick strike running here. I've got the news feed here as well. All right. So again, so I've got about 10 seconds left. It's the highest according to forecasters is 2%. And the lowest of minus 2.1. What do we get? Get that there. Okay. Let's jobless claims worse than expected. Minus 0.9%, minus 0.9%. That's lower than the forecast of 0.5% for GDP quarter-on-quarter advance. So again, a negative reading there of minus 0.9%, lower than the forecast of 0.5%. Seeing the dollar yen going down, S&P 500 going down as well. Gold, that's the 2-year bond going up. Gold, let's grab gold. Gold will obviously, yep, gold going up as well. So much worse than expected data there from what we've seen. So similar reaction to what we'd seen last time with the GDP data that we had last time round. I think so. What we're seeing is more of a bigger reaction on the S&P compared to what we've seen last time round, though. Maybe just off of how instantly it kind of reacted. It's okay. Let's do some measuring here. What was the first? Okay, so that's about 30.5 pips on the dollar yen. Gold. Let's do let's do gold. Let's grab gold. We can see how the S&P 500 before the data had come out was whipsawing. It's about 64 ticks up on gold and 2-year bond prices. We'll also look at the NQ and the Dow Jones as well. 38 ticks up on the bond price, 2-year bond prices. So the yield, remember, heading lower. Bond prices go higher. S&P. So 26 ticks down. Wow, S&P. Whoops, hating that figure. Not loving it. Just trying to see what else there is. Okay. So that's there. All right. So it was as expected. So we were looking for, if we did get a negative reading, that we expect the dollar yen to go down, or the dollar see depreciation, and the S&P 500 bond prices to go higher, and gold to see an appreciation. Let's look at the euro dollar. See if there was if it was just the dollar yen that had seen the biggest reaction. Oh no, okay. All right. And that has seen a much bigger reaction compared to what it had seen last time around. I think again it's more traders taking this in as that second quarter growth, second quarter decline of GDP is seen as, that the US is in a recession. Well, nada. I still think we need to see. The problem is we've got non-farm payrolls figures and the jobs data that is still hovering around the 400k mark, which we kind of need to wait for it to kind of really decline down. We need to see consumer spending completely drop off and go into the negatives as well to say, yeah, we're in a recession. So this is a mixed bag, really. You've got COVID having had an effect in the past. You have Russia-Ukraine conflict having an effect on energy prices and agricultural prices, making it harder for businesses to make those goods, and also supply chain issues too. So, just look at the NQ. Okay. market's now reversing. Well, so far the S&P is. Dollar's still going down. Look at the NQ. Okay, it's about 89 ticks down. So a bigger reaction compared to what it was last time round. Okay, and about 39 ticks down on the YM. So S&P 26, NQ 89, YM 39. And I'll finally do the 30-year bond too. That's important. It's the longer term bonds. Probably didn't have that much of a strong reaction compared to its other counterpart, the 2-year bond price. We'll check. It's about 15 ticks. So yeah, 2-year bond had a bigger reaction. Of course, the shorter term rates, where the Fed has the bigger amount of control, had seen the bigger reaction there. All right. So if you're watching the screen so far, and you can see you can see tick strike going off here at the moment. So if you're not familiar with what tick strike is, so tick strike basically allows you to listen to order flow and allows you to see that order flow too visually. So what it does, it just as said, it's for me, the simplest way to explain it is how much buying or selling momentum is there within a certain instrument, right? And currently at the moment, seeing a little bit of selling on the dollar yen that's occurring. So what I can do, so remember there is different levels of sensitivity. So one is being the most sensitive to market reactions, where you get if you get a little bit of movement up or down, then the markets then here, see, so tick strike will go off even with that little move towards the downside there. And then 15 being the least reaction or the least sensitive to the market reactions, when you're looking for big moves within an instrument, then only then will tick strike go off, and then that's your signal to do whatever you want to do with it. So 51 being the most sensitive, 15 being the least sensitive. So you're looking for a bigger amount of momentum on the level 15. You can chop and change that however much you want. That's all, you can do that there with the pro version of tick strike. And that's something that we want to provide to you guys as well, is the 7-day free trial of tick strike. So I'll put that in the chat there for you as well. All right. So that's in the chat there for you. Now, of course, you've been watching the Financial Juice site, and you've also been looking at the data too. Of course, I have the sound turned off at the moment because otherwise it will kind of confuse me, distract me, as I have done for tick strike. But you get real-time voice and text news that comes through in one place on the site here. Okay, if I kind of zoom, there we go. So you've got the voice feed there, you've got your text headlines or your news feed here that are coming through. So this is, if you're not familiar with what a live real-time voice of text feed service is, this is something that investment banks have access to, right? This is high-level data and knowledge and headlines that investment banks have access to be able to manage their trades and capitalize on potential trades, right? So this is something that you can also have go at as well and have a little play around with a 7-day free trial of Financial Juice Pro. Now, key thing, what's the difference? Well, your question might be, what's the difference between Pro and the light version? So the Pro version of Financial Juice has no delays, no adverts playing at all. All the data is real time with the voice and text. Okay, and also the economic release and also the economic releases too. So if you were looking at the, if you were putting in your forecast figure or your own, you can also put in your trigger for economic releases. So ignore this number here where it says spot 5% or spot 5. That's just the forecast figure. You can do whatever you want to do. You can set your buy and sell alerts, for whatever you want to do. And then when the release comes out and it matches your trigger for the economic release, what it'll do is it will show you whether either a buy or sell sign there, if the figure marries up to what your trigger is in real time, as instantaneously as soon as the data comes out. So that's also in real time as well, whereas on the live version that's delayed. And then, as said, that's already there. So have a little play with the 7-day free trial. If you like the content that I put out for you here, if you like the video, don't forget to, like and share the video with your friends and subscribe to the channel as well. Also, follow us on Twitter too. Follow Macroace or Macroachi. Macroace on Twitter. Show us your love and support. And also, if you like this content, then you can also sign up to the mailing list as well for Macroace. Now, what I do in the mailing list, what you might be asking, is I put in every week or every weekend what to expect for the week ahead, right? And that's covering the Asia session, the US session, the European session. So here we go. Let me get TickStrike out of the way for a second. Close that down. But yeah, so what I do is provide the week ahead here. So you've got the timings of the releases that I'll be covering over when the live stream starts. The week ahead for Asia, Europe, and the US, and the summary of the weekend news. So on top of that you get as a PDF, I also provide the deviations, okay, of what I'd shown you before. So if there we are, it moved it all out of the way. So here we go. So I also provide the deviations for the economic releases or the upcoming economic releases that I'll be going through. So here we go. So I did the FMC yesterday or last night. You see the market data was as expected. Didn't see too much reaction. Didn't see too much reaction from the markets. It was a whipsawing on the first candle. Okay, and but again, there wasn't too much reaction. But this sort of data that you can kind of look at, okay, what is the forecast figure and what was the actual figure? How much did the markets actually move? Right, that data is provided to you as well in the week ahead that I put out every Sunday. So just once a week that I put out that report for you together. And of course, not only FMC rate decision, GDP, retail sales, Bank of England, Canadian CPI, rate decisions, ISM, a load of other different releases that I cover. Some of the releases you'll find that, there'll be other releases that'll take more importance. They'll be more important depending on where we are in the business cycle and what sentiment is, within the markets. What is the focus of the markets at the moment? Is it jobs or is it inflation? Or is it the GDP figure like it is now? Now that we're in, we've had the second quarter or consecutive contraction within the US economy. Those sort of things that I kind of look out for, see how the markets react to the data, whether or not it's still important to look out for. Is it tradable? Those sort of things. But that's all, that's all the data that you can look out for the upcoming releases that I provide for you in the email that I put out to you. But other than that, ladies and gentlemen, dollar is, wow. How far has that gone? That's down 71 pips. Holy moly, that smoked the markets. Smoked the dollar. Euro dollar, let's see, where are you at the moment? Okay, right. So the biggest reaction then from the dollar. And actually, let's just check cable for a second. See what cable did. Okay, yeah, not too much reaction. Now it's about 19 pips up. Okay, so the dollar yen seen the biggest reaction compared to all the other areas. 2-year bond, the 30-year bond price still going up. Gold still flying. So is the 2-year bond price. Whereas indexes have kind of had their fill, is what it looks like. And now I'm moving back. Now I'm moving towards the upside here. Alrighty. Thank you very much. Somebody's got Provesh Kenneth says Tick Strike is amazing. I can hear the movements of the market and highly recommend. Thank you very much for your feedback there. Also, don't forget to provide me with feedback on how I did with macro race. Did I kind of flounder, or was it not? Was the information not good enough? Oh, also one more thing. Do not forget, dun, 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 unusual activity. So something that we're beta testing. It's a product that we have had before. We a relaunch of the product basically. So if you like trading unusual volume activity in stocks, then you can join the free beta test group of our new service. So that's been put into the that link has been put in there for you to be able to jump on and become part of the beta testing group as well. Other than that, I think I think that's it. All right. I won't be doing consumer spending tomorrow. Didn't really have too much reaction compared to what it was last time round. But yeah, that is it. I will see you next week. Don't forget, next week is non-farm payrolls. Dun dun dun. We'll actually start to see the effects creeping in much more of this second quarter GDP into the economy of the US. All right. Sayonara, everyone. Have a lovely day and enjoy your week and weekend as well. Goodbye.